Hey everybody, good to be here. My name is Brent Moore. It's time for Managing Your Options Portfolio. We do this each week at this time on Wednesdays, and just glad you're here. We're going to talk about option management today, as we do each week. We'll look at some existing positions and we'll talk about some considerations. Today, I want to talk about exiting long verticals and different possible exits on long vertical spreads. But we'll get to that in just a minute. Before I get too far, though, let me just acknowledge that Mr. Ben Watson is in the chat helping me out. Ben and I were on Trader Talks earlier today, and then he followed up with a class on index options. If you're interested in more in index options, make sure you check out that webcast. It occurs each week right before this webcast. So glad Ben's here. He's very knowledgeable on the things I'm going to be going through today. And as you have questions, feel free to type those in the chat between Ben and myself. We'll do our best to get your questions answered there. You can also follow us on X at Brent Moore CS, at Ben Watson CS for more content throughout the week. Now, let me just mention a few things. We are talking about options today, and they do carry a high level of risk and are not suitable for all investors. And multi-leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the paper money software application, which is what we'll be using today, is intended for general informational and educational purposes only. And let's see, for the sake of simplicity, I'm probably not going to factor in commissions or fees and transaction fees and what we're talking about today, but just realize they're something that you need to consider. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including potential loss of principal, and past performance is no guarantee of future results. It's good to see some familiar names in the chat. Thanks for joining me. And those of you who are new, we're glad to see you as well. And if you're watching on a recording, I'm glad to have you here as well. Let's head on over to the Thinkorswim platform. I have a 20 and a 50-day moving average on the charts, by the way. The 50 is in blue, the 20 is in red, and you can see we've just been chugging along here. This was an all-time high right here. We're right on the verge of that. 64.81 was all-time high. We're at 64.79 right now. So we could see that intraday. Of course, we have earnings on NVIDIA coming out after the close today. That could certainly push things. Now, when we're talking about managing an options portfolio, there's different approaches you can use. And the approaches that we use typically, well, they're going to differ between the type of strategy. I want to focus on long verticals here at this first part of our webcast, and we'll get to some other types of trades later. But with long verticals, one thing I would say is typically in this webcast, we're not holding them till expiration. Now that is true for long verticals, and that's true for most options trades we do here, is typically we're not holding them all the way to expiration, although there may be some exceptions to that. In fact, we may see an exception later today, later in this webcast, as we're managing some things. But typically, we're not holding them all the way to expiration. But there's other ways, other considerations in management I want to consider. And often in management, we're talking about, like, what are we going to do to exit this trade? And here's a kind of three general approaches. One, we can manage by putting exits based on the option price, okay? The option price is one way to do it. That's what I want to focus on a little bit more today on. Another way to approach that is to manage it by focusing on exiting based on what the underlying stock price is doing. And one reason I'm not going to focus on that today is what I kind of the typical approach we do in this webcast, and most of the webcasts I do with options is I do this a lot. We manage it based on the underlying stock price. So maybe we have a call option or something on SPX, which is an index option. You can actually put an exit based not on the option, but actually on the index value here in this case. But I'm not going to talk about index options much today, but just realize that's another possibility. Here's another possibility. Possibility number 3 is we don't really touch it. And why would that be a consideration? Well, one reason is this. This is a spread trade. The reason you're doing a spread trade is you're limiting the risk by adding the additional leg on there. Like if I'm doing, say, a long put vertical, okay? Let's say if I'm doing a long put versus a long put vertical, I could do a long put on a stock. Well, I can also do a long put vertical. What does the long put vertical do as opposed to the long put? The long put, we're buying a put. We're going to buy a put, and it's going to cost us a certain amount of money. It's going to give us a certain amount of risk. With a long put vertical, we're going to buy a put. We're also going to sell a put. By selling the put, we're bringing in some credit to offset, partially at least, the debit of the long put, and it's going to reduce the risk. It's going to limit the gains, but it's going to reduce the risk, and therefore, when we do so, since we're reducing the risk, we may feel less urgency to do a stop loss on it. So that's kind of the third approach, and that's not the one I'm going to do today. But on vertical spreads, often we may do that because we're constraining the risk by putting in that vertical spread in the first place. Okay, I'm hoping that is making sense, everybody, for you. Let's go ahead and I want to focus on that first one, but let's hit up some questions here. Okay, so Josh said, regarding long verticals, can you address the best practice when to purchase versus when to leg in? Okay, so when do we enter long verticals? Well, there's 2 types of long verticals. I think a lot of you know this. There's long call verticals. There's long put verticals. Long call verticals are bullish. Long put verticals are bearish. Generally, when would you let's just focus on long call verticals for now, okay? When would I do a long call verticals versus just a long call? Well, if in both cases I'm bullish, but if I'm more risk conscious, then I may, and I'm willing to forego the potential gain, because we're limiting not just the risk, we're limiting the gain, then I may target that long call and say, hey, it's worth the additional risk to get the additional reward. But let's say we buy the long call and it's doing pretty well, but we think maybe it's kind of made some of its run, or a good portion of its run, or we change and we say, well, maybe I want to limit the risk because I only think it's not really going to take off gangbusters here. Instead it may just go up a little bit. Then we may choose to leg in that long call vertical in the first place. So really the initial consideration of long call versus long put is just, are you willing to give up risk in order to give up willing to give up reward in order to limit your risk? So why would you leg in? You'd leg in if you think initially you're probably going to get a strong run, and then after that occurs, you want to limit the risk and you're willing to give up some of the potential return there. So that's, typically long call verticals itself, we're not legging into, or long put verticals we're not legging into as often, would be my take. We may do it at times. It's not like an iron condor or something where often we'll leg into one side and not the other there, because the difference between, say, an iron condor and a long put vertical or an iron condor and a short put vertical is, one is more neutral and one is bearish. These are both bullish in this case, or both bearish in that case. Okay, all right. If you are legging in, you would use the same expiration date, or else it's not a long vertical, okay? Now you can leg in, but then what you're going to end up with is diagonal spread if you're using a different expiration date on that. Okay? All right. let's move forward here. So I kind of went through the three general categories. I want to give you an example here. And for an example I want to do, I'm just going to go to Apple, little company you may have heard of, Apple. And what I'm going to just kind of start with the technical analysis. And I'm going to say bullish here from a technical standpoint. I'm going to say the trend is up. We've been going above our 20-day moving average as well as our 50. We've had a nice little bounce here. Looks like it's potentially even kind of a flag type pattern. Okay. Break. In any case, looks like it may be a bounce, and I'm going to take a bullish approach on this. Now, we could do a long call, but I'm going to look at a long call vertical in this case. So the consideration in terms of what strikes you're going to do depends partially where your stock price is and where you think the stock is going to go. Here I'm going bullish. I want to give it a little bit more headroom here. So I'm saying, well, it could easily go up to where our recent high was. Now, this isn't super bull. This isn't saying it's going to go up to 250. If I felt this was realistically going to go up to 250 in the near term, I'd probably just do a long call. But in this case, I'm saying, well, 235 seems reasonable. So that's where I'm going to put my my short call. That's going to kind of limit my gains there. And then I want to put my long call kind of where I don't think it's going to go below. And well, I think this is going to continue its momentum up. We may go to like 230 or a little bit below 230 for our long call on this. So let's take a look at our possibilities on this. Let me get out of my little drawing tool. I'm going to go to the trade tab. And then I want to talk about exits on this after we do this. I'm just going to go out. This is a fairly quick move. I'm going to go out to I'll go out 23 days here. And we're going bullish, and we said 230, maybe a little bit below. We got a 227.50. That's going to be my long call. I'm going to click on my ask price. That's my long call. We said 235 was going to be my short call. I'm going to hold down a control key. Click on that, and that gives me a long call vertical. Now, my initial debit here is about 388. That's the mid price. I'm going to make math a little easier if I go to 390 on that, okay? And more likely we're going to enter this trade on this, okay? So 390. So if we're going to put an exit point, not based on the stock price, and not just let it go, and we're going to do it based on the option price on long verticals, what I'm going to do is I'm going to say, I want to see how much I can make on this, how much I can lose, and just use a percentage of that. Okay, so I'm just going to click on confirm and send, and we're going to make it nice and easy here. Max profit is 360. Okay, I'm going to look to get out if we can get 80% of my max profit. Okay, now, 80% is not a recommendation. Maybe you use 70%. Maybe you use 60%. Well, there's not an exact figure on this. But on this, I'm going to say 80%. So I could take that 360, and I'm going to multiply it by 0.8. That's 80% of 360. This is my max profit, 360. 360 times 0.8. I'm using a calculator here. 288 is my max profit. Excuse me, is 80% of my max profit, 288. Now I'm going to do the similar thing on my max loss, which is 390 is my max loss, but I'm not going to do 80% on that. I'm going to make it a little tighter. So I'm going to go 50% of that. I'm going to go 3.90 times 0.5. Now, if you're good with math in your head, you probably don't need to use the calculator, but I'm going to use that there. And that's giving me 195 is half of my max loss. So let's talk about exits here. Let me go back and click on edit. What I'm going to do is I'm going to make this a first trigger as OCO down here. I'm going to right click on this order, and I'm going to create an opposite order to get out here. And I'm going to do another one of those. So I've got my exit orders. My exit orders are going to be good till canceled orders. I have one which is a limit price. Now, what am I going to do? Remember, we said our max profit was 360. 80% of our max profit was 288. Well, for me to make 288, and this is where it kind of confuses people sometimes. For me to make 288, what does this need to go to? Well, my entry price is 390. I'm going to take 390 and I'm going to add 288 to that. I'm going to use my calculator on that. 3.90 plus 2.88 gives me a target price of 678. I'm going to change this to 678. That's my limit. Limit means that's my target in this case. Limit means my target. So let me get out of my drawing tool. Let me just, for clarity, let me just change this one already, and I'm going to make that a stop. But we said 390 plus 288 is 678. Now, is everybody clear on where I got that 678 from? I'm going to, just at the risk of redundancy, let me just mention it one more time. I started out with our max profit, okay? I did that by, to be honest, I clicked on confirm and send. It told me what the max profit was. I multiplied that by 0.8, and you can use whatever figure you want there. And then that gave me a value. That value was, I think I wrote it down, was 288. I then took that 288 and I just added it to my entry price. That's how we came up with this, okay? All right, now let's do a similar thing for our stop, okay? We're starting with 390 and we said our max loss was, well, 390 is our, was our max loss on that. Okay, 390 was our max loss. We multiplied that by 0.5. We came up with 190, supposed to be a 9, 195, there we go. And I'm going to subtract 195 from this. So I'm going to take 390, I'm going to subtract 195, 390 minus, and because it's 50%, it's going to work out just to be 195. And so we're going to put 195 here on that. Okay? All right, any questions on that before I proceed here? This is an exit based on the option price, not based on the stock price. Make sure they're good till canceled on those, and then I can confirm and send. Now, when I click on confirm and send, and I look at these numbers here, they're not going to reflect us getting out where the stop loss is, because stop losses don't guarantee what execution price it's going to be at exactly. This could gap down and go to zero. Technically, we could lose a 390, but we're going to bank on it, hopefully getting out at that 195. That's the goal there on that, okay? That's how we can do it. That's how we can make this calculation on long verticals. Long verticals are a little more complicated than others, which is why I'm taking a little more time on these than what I do on, say, you know, just a long call, putting a stop on that. It's a little bit easier there, okay? So let's answer questions. Myron said, why did I multiply it by 50%? Because that's where I'm putting a 50% stop loss on this. Now you may go, I don't want to lose 50%. We're entering at 390. I want to get out at 380 or something. Yeah, I do too, if it goes against me. But the reality is options are volatile enough. You're likely just going to get stopped out on in just a few minutes on just an intraday little intra-minute swing on that if we go too tight. So that's how I came up with that 50%. 390 was the initial price, 50% of the loss there, okay? And why is one a limit and the other a stop? That's another good question. I appreciate you asking that, everyone. Let me go and just click on edit again. Why is this a limit? This is the target price. If the price goes up to this or greater, this will trigger to get us out. That's a good situation. That's getting us out at a profit. This is a stop. Maybe necessary, we want to use it to try and help protect us. It's not guaranteed, but to protect us, to the extent that it is. But it is if the stock goes down. If I accidentally put a limit here on this one, it would trigger right away because it's saying get out if it's at 195 or higher, if that's a limit price. This is stop. It's get out if it's 195 or lower. Okay. Same with the limit. If I made this a stop, this would get us out right away. It would trigger right away. So that's why we have that. I'm going to enter that. I'm going to put that in our long verticals bucket and send. Okay. There we go. And it's filled and we've got one. Now, I'm going to go through one other example and then I want to go to trade management because I don't want to neglect that. And I like to give you a variety of examples. So I'm going to go with more of a bearish example here on this. I'm going to go to Comcast. Okay. And here's my technical analysis theory on, and you can agree, may think this is bullish and just going to go up from here. But my take is this. We have what I would consider kind of some resistance here on this level. Okay. We have resistance on this level. My drawing tool isn't really drawing there. Well, a little laggy. And we just bounced off that right here. And so I'm going to consider this to run a little bit. And I'm not sure it's going to go way, way down, but we're at 33.70 right now. I could see this going down to maybe 33. So not a super ambitious target. Again, if I did have a super ambitious target, maybe down to 30 or even 31, maybe I wouldn't even do a vertical in this case. Maybe I would just do a long put. In this case, we're just going for a little bit of a move down here. So I'm going to say maybe we'll target around $33. And I'll put, I don't think it's going to go above 34 much. I'm going to get out. I'm going to want to get out if this thing reverses on us here. Okay. Now, could we do this based on the underlying stock price? We can. Again, as I mentioned before, we do this quite often in this webcast. So today I'm just want to give you the examples of doing it based on the option price. So let's do a similar thing that we did here. And I'm not going to be super creative on this one here. I'm going to go to the trade price, the trade. I'll stick with the 23 days to expiration at September 19th. We're going to puts now. And we said like 34 long put. I'm just going to click on that with my cursor. I'm going to go to 33. That was kind of my target. I'm going to hold down my control key, click on that as my bid price, and there I am right there. Now, remember the first step. The first step was I just wanted to see what my max gain and what my max loss is here on this. So I'm going to click on confirm and send. And I've got a max gain of $56, a max loss of $44. Okay. I'm going to do the same thing. Now, we can tweak this to 70% or 60% or whatever on either of these, but I'm going to use the same formula I used before. I'm going to say 80% of my max profit. So 80% of my max profit, I'm going to take 0.8 on my calculator. I'm going to multiply it by 56, and I come up with 44.8. I'm just going to round that to $45, okay? $45 is going to be 80% of max gain. And I'm just jotting that down so I don't forget that. Max loss, $44. Again, I'm going to use 50%, so that makes the math easy. I'm not going to use my calculator on that one. And that's going to be $22 is 50% of max loss. Let's enter the trade here. Okay, now it's a cheaper option. Maybe you do more than one contract. You can do that. There's a couple contracts. And what I'm going to do is I'm going to make this a first triggers OCO. And all a first triggers OCO means this is my entry order. And I'm going to do some exit orders here. And these exit orders aren't even going to be active until the first order triggers there. Now, I'm going to make these good till canceled. My exit orders. My entry order doesn't need to be good till canceled, but my exit orders, I don't want my stop to expire in, a few hours from now. Now, here's my prices. One's a limit, one's going to be a stop. The limit is the target price. We said the target price was going to be my entry price plus 80% of my max gain. That's 45. 45 was 80% of my max gain. 45 plus, not times, 45 plus 43, 88, which I guess we could have figured that out in my head too. 0.88, that's my target. My stop at 50%, and 50, that was because my mid price, let's see, the price has changed a little bit on me here. And my initial price, let me just do this. I'm going to go to 55. And half of that is going to be about, let's see, we said max loss is going to be $22, okay? 0.22. That is not, did my price change on me here? Let me just look. I think that was going in at the mid price. I'm actually going to change this calculation a little bit because I'm not going to go right at the mid price. I'm going to go right at 50 cents here on this, okay? And I'm just going to put this in at 25, which is going to be half of that value. And I'm going to confirm and send, okay? There's my order, and I'm going to just throw that in my long verticals bucket, and I'm going to click send. We'll see if it filled. It's possible, by the way, that would fill at the mid price. Typically, my suggestion to you is that it's unlikely to fill right at the mid price. Now, you can put it in the mid price and see if the market moves a little bit and give it some time and see if it fills. Or you can move it a little bit off the mid prices, which is what I just did, to try and get a more likely to fill. You don't necessarily have to go all the way to the natural price, but go in between the mid and the natural price, and there's a good chance you're going to get a fill on it. Okay, so there's our trades on that. That's the kind of the way to do these trades based on max gain, a percentage of max gain and a percentage of max loss. Now, so there we go. Now, I want to talk about managing positions here. Because one thing I said was, we're typically going to get out of most positions if we get close to expiration, before expiration. We're not going to let it go all the way to expiration. There may be some exceptions to that. And let me just show you one. And it's this. This is in the money. This is AMD. Now, if you look at AMD, we have a little note on that. I put a note on this just to remind us in this webcast. This is what we call a wheel strategy trade, okay? And the wheel strategy trade is this. We sell a put, and if the stock goes down, we buy the stock. Okay, we get assigned at the put strike, and then we look to sell a call. Well, we did this 1 month, and we sold the put fairly aggressively, I think. We brought in a credit, but the stock never went down below that level, so we did it another month. We sold another put, and we sold that other put for $535. Well, what happened? AMD went down. And so often you may go, well, I don't really want to buy this. But the whole purpose of this trade as part of the wheel strategy is we're looking to get into a position here on this. So what am I going to do? Nothing. I'm not going to get out. I'm just going to let this get assigned to me, which it likely will. There's no guarantee, I guess, but it likely will because we're in the money. It's a 180 put and the stock's $14 below that right now. So now we could see a significant move, I think, on AMD, maybe based on NVIDIA earnings tonight. Who knows? But still, going in the money is going out of the money on this is probably unlikely in this scenario. So we're just going to let that sit. So sometimes there may be circumstances where you let it go all the way to expiration. So I'm not even going to touch that guy here. Okay, let's look at another one. Here's an iron condor. Now, one thing I always say on iron condors is you can manage your calls and your puts separately. We're going to manage this as a put vertical. We're going to manage this as a call vertical as well. One easy way to do it is just look at where the stock is. The stock's right around 366 right now. What are our strikes? Well, our short strikes are 315 and 400. Stock's kind of right in the middle of that. There's no urgency to get out. We got 23 days to go to expiration. If we were under 10 days to go to expiration, we may just look to get out. But we've got quite a bit of time. The stock is not really threatening either end. And so we're just going to let time decay work on this. Time decay should be helping us out on this. And it is to the tune of about $5 a day. We'll see what happens. The thing with iron condors are this. It's not really doing much right. In fact, we're down $2 right now on this, okay? If you're looking for a quicker moving trade, iron condors are not the trade for you typically, okay? Iron condors can be very slow, so we need to let it work as long as we can. And in this case, we're between our strikes. We're just going to let this work. We're not near any sort of max gain on either of these, but it's also not disastrous either. So we're going to let Adobe sit here, okay? Let's look at another one. Okay, let's look at Alphabet, okay? Alphabet, what is this trade? This is a short put vertical. We've got a short put at a higher strike than the long put, same expiration date. That's a bullish trade. We want the stock to stay above that 190. Here's the thing, we only have 2 days to go to expiration. Yes, we're making some money on this guy right now. We're making some money on that, but that's not why we're getting out, okay? If we were losing money, we'd be getting out too. We're getting out because we only have 2 days to go till expiration on that. So what I'm going to do here is I'm going to click on these and I'm going to create a closing order and I'm just going to get out of this vertical. We're going to take our profits and run on that and confirm and send. 2 days to go to expiration. We're definitely getting out on that. Okay. Ricebird said, yeah, Iron Condor is kind of impatient with Iron Condors. You got to have a lot of patience with Iron Condors, to be honest. So a lot of people don't really like them for that reason, but you know, there's different trades for different types here. Okay. Now let's look at Southwest because we have another Iron Condor. And remember, we're going to divide it up into the put side and the call side. First off, let me just look at the stock. The stock's at 33 bucks. My put side is doing quite well, right? My puts is a 29.30 put vertical. We want it to stay above 30. It's well above that right now. You can see our profit loss on our puts right now. We're up about $90 on that. And frankly, we've made most of what we can make. We sold this originally, the put side of things, for about 32 cents. Right now, it's about 9 cents. So we've made most of what we can make. We're going to manage the winner on this to start. We're going to get out of this put. We've made most of what we can make on the put vertical. So we're going to look to get out of that one. What about the call vertical? Well, we're kind of on thin ice on that call vertical. The stock's right around 33. Our short strike on the call is 33, okay? So we're kind of iffy on that. And so we got to decide, are we still neutral on this? Are we bullish on this now? Or are we bearish on this? Now, Greg brought up a good question. Can you roll it? You can roll this. And would you roll it? You can consider rolling. We got 16 days to go to expiration. If you're still neutral on this and you still think, hey, if you think this is going to go more in a sideways pattern, well, this is kind of looking pretty bullish right now. Actually, I would say that trend is fairly bullish on this. So it brings up a broader question, not just on this trade, but on other trades. When you're considering rolling, don't worry about the trade you've been in. Worry about the trade I'm on Love, wrong chart. So sorry about that on everybody. The question was on Google, which we already looked at. We could roll Google. Yeah, we could if we were depending on the trade. Absolutely. We only had 2 days to go to expiration, so we can look to enter a new Google trade, new Alphabet trade. That is no problem at all, Greg. And I'm not going to take the time to do that right now, but absolutely, that may be a candidate to enter a new Google short put vertical on there. On Love, we're heading up. So this is Southwest Airlines. We're kind of at this precipice right here, okay? I'm looking for a bounce down. We're down a little bit today. Is this going to hold? I don't know. I really don't know. We're kind of near that 50-day. Are we breaking through it? So am I going to get out of both sides? Maybe. But what I could do also is I could say, I'm going to give this a little bit more time, but I want to put in a stop loss on this. And we can do that. So let's go back to Southwest Airlines. First of all, I'm going to get out of the put side of the equation. We said that one was good. We've made the money we're going to on that. I'm going to just get out of that put side of the equation. And let me go and confirm and send that. Hopefully that gets us out. Okay, now we're just looking at the call side. Well, we had a nice little profit before, but now we're not going to see that. We're going to show the loss because we're just looking at that call side of the equation. So now what we're going to say is, look, I'm just going to cut bait here if this doesn't bounce. I'm going to do this exit based on the stock price. Based on the stock price. So I'm going to say if this stock hits 34 or higher, if it goes up, keeps going up, I'm just going to get out of this trade. So here's what I'm going to do. I'm going to go to the monitor tab. I'm going to go to my calls. I'm going to right click on it. I'm going to create a closing order. To buy it back, I'm going to change this to a good till canceled order. I'm going to make it a market order, and I'm going to click on a gear. And the gear is just going to say, look, if this goes above $34, I'm getting out, okay? Greater than or equal to $34. Now, you may notice that this $34 right here is the same as my short strike. That's more of a coincidence than anything. If you deem it to be, if the area of, you want to get out at doesn't equal that, that is no problem at all. So that's just more of a coincidence than anything, but we're going to get out of this trade in that case. So we're going to add protection is the point here if the trade continues to go against us. So we take a profit on the one end. This end is a little bit more iffy. We'll just see on that, but we've added that stop on there, okay? All right. Now, there's one more trade I want to get to, and because I want to show you something kind of specialized on this. This is Adobe. And let's look at the initial position. Here's Adobe, and I've got, hold on. I think I have two Adobe trades. I don't think that's the one I wanted to point out. One sec. There we go. So here's Adobe. I have a long put on Adobe. Well, let's just look at the long put. Right now, we're doing great on it, okay? It's making money, awesome. Notice there's no stop on this, okay? So I'm going to look to possibly exit Adobe if it turns bullish on us. We want it to go bearish. Remember, this is a long put. We're bearish on this. And in this case, we've talked about putting stops based on the option price. We talked about exiting based on the stock price. Can we put an exit if the stock breaks above a moving average? We sure can. What if we say, I don't want Adobe to break above this 50-day moving average? The blue line here, this is a 50-day moving average. Can we do that? The answer is yes. You can say, I want to get out if this breaks above the 50-day moving average. So these are all varieties of ways of doing stops here. Let's show how to do that. So first of all, I'm going to go to Adobe. I'm going to say, I'm just going to create this closing order. Okay, we're going to get out of this long put if it breaks above that moving average. And so what I'm going to do here is this. I'm going to make this a, good till cancel. I'm going to make it a market order. I'm going to click on the gear, and I'm going to say we want to get out if Adobe, ADBE, right here under conditions, and instead of mark, we're going to do a study. Normally, if you see me, I'm doing mark here. Here we're going to do a study. So I'm just going to do a study. I'm going to edit this. I'm going to delete this. It puts in a default one. And I'm going to say, I want to do this if, I'm going to add a condition here. If the stock price, now there's different stock prices. There's the ask price, bid price. I'm just going to say the closing price is greater than the moving average. Well, that moving average is a study. So I'm going to click on study here. I'm going to put up a simple moving average because that's what I had. Simple moving average. And it's a 50-day. So I'm going to make this a 50-day, 50-period moving average. Okay, I'm going to click on save. I'm going to click on OK. There we go. Adobe meets this, that this condition is true, that it's above its 50-day moving average. That's an exit based on a study, based on a moving average there. I'm going to click on confirm and send, and I'm going to send that in there. Now, Laura said, cool to see, but too fancy. That's just overly complicating the thing. Absolutely, that's fine. And no problem with that. I thought there's some traders out there that would like to see that and how that is done. So I wanted to model that for you. So, hey, I showed you a multitude of ways of putting stops in on different types of trades today. I'm hoping that was helpful for you. That was the goal today. Thank you for joining me, everybody. We started off with long verticals, talked about how to possibly calculate stops, one way to calculate stops, and target prices based on the option price, not the stock price on those, because that confuses people. We talked about managing other types of trades as well. And there you go. That was the goal. Thanks, Ben, for helping me on the chat, of course. And thanks for each of us joining us. Thanks for each of you joining us today. Coming up next, we've got trading price patterns. Make sure you check that out and follow us on the Trader Talks channel. Everybody, have a wonderful day, and we'll see you all same time next week. Bye-bye.